Hello and welcome to episode 292 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How you doing?
I'm good. I'm really good, actually. And I did something for the first time ever money-related this week, which I was quite impressed with. People listening to the podcast will probably think maybe I'm behind the times, but I paid in a cheque via a banking app this week. And I mean, I don't get checks because it seems a bit of a dated way, but I had a refund from a company that was sent by a check. And I thought, do you know what? I think that's a bit of a ruse that they thought I wouldn't actually, in this COVID era, go down to a branch and actually pay it in because it wasn't for a huge sum of money. But then I remembered that one of the banks that I bank with allow you now to do it via the app because not every bank does.
No.
And I was quite impressed. Yeah, so I felt like I'd achieved something, even though everybody listening to this podcast is already bored of that story. But yeah. What about you? You had a good week, Andy?
I haven't banked any checks in, although I have done that before on I've done it on two different banks because I've changed banks in the last couple of years. Not the same check. No, not that dodge. Two different checks, two different banks, two different times, and it worked both times. So it is impressive how things have moved on, but I suppose, that's what they need to do these days, and they are getting rid of checks slowly but surely. So
yeah, living the dream, Andy. We're living the dream. But obviously, aside from checks, the real exciting news, obviously, is the live event we're doing on Monday evening. So it's 7:30 on Monday. Do listen in. We're doing a live event called Property in a Pandemic Is Now the Time to Move. Now, if you recall last year, we did our first ever live event and we did it in London and it was a physical event that you could go to and it was attended. It was brilliant. It was filmed. We had a great time. That was the living a champagne lifestyle on a lemonade budget. So obviously we can't do live events in person anymore. So we're doing the live event online. If you go to the show notes, there is a link to be able to register your interest via Eventbrite. And the event is really a panel event. I am hosting the event and there is Purple Bricks on the panel and Habito, the mortgage broker. So we're going to be talking about everything to do with property, the property market, what could happen to property prices, what's going on in the lending market. So are lenders becoming stricter? What are they looking for? The hurdles you're going to have to overcome if you're trying to buy and sell in a house. Is now even a good time to do it? So do listen to that event. It'll be on YouTube, it'll be on Facebook. Details will be in the show notes and the post that is relevant to this particular show that we publish on the website every week. And you can also send in your questions that we will ask anonymously for you to our panel guests and experts. The email is damien@moneytothemasses.com as usual. So do make sure you send them in. I'm so excited about it. I think it's going to be a fantastic event. So what we'll do is next week's show, doing a bit of admin here, but next week's show, we will take the highlights of that to create next week's podcast because the event is scheduled to last at least an hour. So if you want to have the whole show, see the whole thing and your questions possibly asked, then do watch live. As I said, Facebook and YouTube. Details are in the show notes, but we will give you some of the edited highlights in next week's show.
Well, talking of admin, we always highlight the group. And I just wanted to point out this week that we saw a record number of people heading over to the group to join last week. And the activity in there has been amazing. So I think I learned something from that. We should mention these things earlier on in the pod. Maybe people switch off.
Yeah, we should mention them in the podcast. So go over to the Facebook group if you've not joined. Facebook.com/groups/money to the masses. There's lots of conversation going on in there. People asking questions, answering questions, sharing their expertise. And it's a very friendly environment. And it's a brilliant and useful tool. So if you've got anything that you want to ask, then head over to our Facebook group. And Andy and I are in there.
It's a great resource for us because it gives us ideas to use on the podcast, maybe write articles on, do some research. So it's brilliant. It's kind of like this cyclical thing where you guys, the listeners, are getting involved and it's helping us too. Right, moving on. What have we got coming up on this week's show?
This week, actually, say this week, by the time you're listening to this, it'll be next week is Good Money Week. So you see these initiatives that are that come along to try and encourage people to engage with their finances. I think we had Financial Planning Week in the last week or two. Good Money Week is about finding sustainable and ethical options regarding banking, pensions, savings and investments. Now, I want to do a piece about making your finances a little bit more ethical. We did a piece about ethical funds and investing, not on investing, but I'm talking more about things like banking, current accounts. So that's the first piece. The second piece we're going to do is relating to private health insurance. Now, people in this environment are possibly and unfortunately maybe having to lose their jobs. They might have medical insurance with work. So what are their options? What can they do? They may be wanting to try and cut the cost of it without losing the benefit, because it can be an expensive product. So what we're going to do is do a piece on that about what people should be doing in this environment, how to cut the cost. And the last piece is another excellent piece by Jordan, funnily enough. He's been a bit of a star the last sort of couple of months on the podcast. We've done a few pieces that Jordan has actually written relating to reward cards.
That's it. So we're going to cover off 4 of the top reward or loyalty cards of the top supermarkets. It's a good time just before Christmas to have a reminder of the top cards, how much you can earn and how you can maximize those points. And again, towards Christmas, every penny helps. So that's going to be a good piece. So what are we going to start off with?
Let's do the ethical piece. So as I mentioned, we've done ethical investing recently. So episode 290, we looked at ethical investing via funds. Go back to episode 248. We've also covered ethical investing to a slightly different angle. So the idea of making your finances reflect your own morals and views is an interesting one. In fact, I've been doing a piece for one of the national journalists this week about ethical investing. It's probably because Good Money Week's coming up. So what I want to do is, we know about green energy. So people may use a green energy tariff. We've talked about ethical funds, but what about other areas of your finances? So can you make them green? Can you make them ethical? And the answer is you can. It may surprise some people, but you can actually get ethical current accounts. They're few and far between. So if you are thinking about being green or wanting your money to reflect your ethics, so do good with your money, then it is possible to do it not just via investing, but via how you save. So current accounts, let me start with current accounts. Now, there are a couple of current account providers out there who are ethical. Now, the Co-op is a cooperative. So by almost definition, the ethics of a company that's owned by its members is well documented. If you go onto the Co-op's website, you will find there almost a charter of the things that they stand for. If you think of them as a brand, and they're even the part of the business to do with food and about fair trade, ethics is very much ingrained in their business model. So if you wanted to look at the current accounts that you could possibly use that have ethics baked into them, then the Co-op is a good place to start. But there are others. So there is a bank called Triodos. So Triodos. So
I see what they did.
Exactly. We before the show, I said to Andy, "How do you say this?" But the clues in the actual
3-2,
name,
right?
Yeah, 3-2. Triodos is an interesting proposition. It's a bank that only lends and invests in organisations that benefit people and the environment. Now, you can get personal and business accounts, and the idea is that they are an ethical bank. Now, there is a fee for having their current accounts. Like I say, they do have business accounts too, but they even go to the point where not only are there ethics about the businesses they will do business with, who they will lend to, but even down to their card itself. The card that you pay with is biodegradable and recyclable. So I thought that was a fantastic idea. So if you want your piece of plastic to be something that's biodegradable that you take to the shops, then Triodos is probably one to have a look at. They do have a refer a friend scheme going on at the moment, and even the ethics of the company are reflected in that refer a friend scheme. While they might give the friend £60, they donate £25 to charity on your behalf as part of that referral, which is quite interesting. So have a look at Triodos if you're interested in current accounts that could be ethical. You can find the full details about their ethical criteria and what they do on their website. But there is another company out there. There's a building society called the Ecology Building Society, who also offer a personal account to people. But interestingly, they do also offer mortgages. And if you are planning on doing an sort of eco refurb or new build, that's the kind of thing that they're interested in loaning a mortgage to. So it is possible to have your current account and your mortgage being both ethical. Now, if we move on to credit, there aren't so many options. Well, in fact, there basically are none when it comes to credit cards. There had been in the past, there had been tie-ups with some charities and credit card companies, but I think perhaps the lines of ethics become slightly blurred. And probably the only one out there, if you want an ethical credit card, is to look at Co-op. Because again, like I mentioned, Co-op being a cooperative, their ethics are clearly stated on their website, then you may feel that that's probably about the best credit card if you wanted something that was ethical. Actually, one thing I forgot to mention on the banking side of things is have a look at Sharia compliant bank accounts. Now, These are bank accounts that bank according to Islamic law. That means they won't lend money to businesses that operate in alcohol, tobacco, or gambling, or go against any other Islamic principles. So you don't have to be Islamic. The point is they are ethical. You don't earn interest on those accounts. It works slightly differently. The way they work is you actually get paid some of the profits that the banks make. It's a slightly different way of doing it. But have a look for Sharia compliant accounts. That's almost like a subset of ethical banking. If you are interested in banks more generally, so you might not be able to find a ethical bank or financial service that gives you the accounts that you want, there are websites out there that look at the ethics of financial institutions. Now, one of them that I came across when researching this piece is the ethicalconsumer.org. Now, they are actually a consumer magazine, but they have an online presence. And what they do is they go along and they will rank companies based on a sort of an ethical criteria and what they do and don't do. And to give you an insight, they will look at, say, banks and building societies, and they will look at those banks, the sort of worst offenders when it comes to tax avoidance. And I will put a link in the show notes so you can go and have a look at the site because there's some interesting findings. But they list a bunch of people who are the worst out there. I mean, HSBC is in that list, which isn't surprising. Tesco is in that list. Sainsbury's Bank, Halifax, Lloyds Banking Group. They even look at things like excessive executive pay, funding climate change. So there are banks that may inadvertently be funding climate change that they deem. So they say that some of the people who do that are Barclays, Citibank, HSBC again, Deutsche Bank, NatWest Group, Santander. And even on the list here, they may have people that have investments involved in funding nuclear weapons producers.
Wow.
And I'm not going to read out those names because there becomes a sense of deja vu in terms of the banks that appear in the naughty list of these things. And they even went down and looked at the banks that appeared in numerous areas or where the ethics were questioned. And some of the worst offenders were Barclays, Citibank, HSBC, and Santander. And that was when they were looking at tax avoidance, directors' pay, funding fossil fuels and nuclear weapons. So it's an interesting read. Go and have a look at it. You can take what you want from it, see what matters to you, and then their scoring criteria. But it's a very interesting read anyway, because it's quite difficult to find the information about the ethics of individual companies from a consumer's point of view. One of the other things in your own personal finances, like I said, you had utility bills, which people can already do very easily become 100% renewable. But I found out...
I just have.
You just have?
Yeah, I switched. In fact, I got the email yesterday saying that I'm 100% renewable energy now. So I'm quite pleased with that.
I'm impressed.
That was just lucky that it was actually top of the list in terms of when I did my switch, but I'm happy.
Yeah, but that's the thing. When you look at the energy deals, but also some of the banks and savings accounts and things that are out there, just because something is green doesn't mean it has to be inferior. We've seen in the past, for example, Co-op having some market-leading savings rates. They do change over time. So it doesn't mean just because something's ethical, it doesn't mean it won't be good value. Interestingly, broadband, there are one or two green broadband providers. So one of them is Green ISP and another one is Green Net, and they're both meant to be not for profit. And what they do is the company is run in a way that is meant to minimize any environmental impact. So they'll try and run data centers 100% from renewable energy. So you can imagine that data centers require a lot of energy, and they make sure that they run them in a sustainable way. So you can even get to the point that you can have green broadband. I mean, I don't know what they're like because they're quite small providers, but they do exist.
Do they have biodegradable wires running under the ground? Because that would be a bit of an issue.
That would be a nightmare. But you have to do a bit of research. It's an area that isn't one that's particularly mature, but I think what's going to happen in future as people want more and more ethical and green versions of everything, we're going to get more choice. And funny enough, even in the banking area where there seems to be some movement, we're starting to see even some of the bigger banks trying to improve their green agenda and trying to create investments that don't invest in fossil fuels. And I know for a fact that a number of the innovators in particular parts of the personal finance world are looking at and about to launch investments that deliberately exclude fossil fuels, because the problem with ethical funds is that a lot of them were, as I mentioned in a previous episode on the podcast, episode 290, they still can contain companies that burn fossil fuels. And so even though generally speaking it may be an ethical fund, but if a business on the one hand has green credentials but is burning fossil fuels on the other, so I'm thinking about some of the big oil companies, then you have to argue, do they balance off each other? And of course, if you're against the burning of fossil fuels, then your answer to that is they don't. So it's very interesting. So there we go. We'll put the links to some of the things I've talked about in the show notes.
Brilliant stuff. So last couple of weeks, actually, we've done ethical investing a few weeks ago. Last week, we were talking about electric cars, and this week we're talking about banking. Yeah, we're doing a bit of a green agenda at the moment.
We are. Do you know what? I hadn't really planned that, but good money weeks come up, and we can therefore just push out some of the stuff we've already done. But I like it. I think it actually reflects a lot of the things that we're both thinking anyway.
Yeah, we're moving that way, aren't we, for sure.
And consumers. On to the next piece now.
Yeah, we're going to talk about health insurance. And we've done it before on the podcast where we've talked about what health insurance is, why you would need it, how best to buy it even. But this is coming from a slightly different angle. The last few months, we've seen people tightening their purse strings and looking at costs. And so this piece is looking at health insurance itself, but how you can cut the costs of the cover if you have it, or even if you're looking to have it, what you might be able to do to cut the cost.
Yeah, and of course, we've also get feedback from partners and we hear what's going on in the industry. And there's been a real move by consumers to look at their medical insurance they may already have from their employer, because that's how a lot of people actually have medical insurance. It's a benefit through work, and they may be leaving the job, being made redundant, and they're looking to try and replace that cover. Like Andy said, or the alternative is that it's a bill they're paying for personally, and they're thinking, I need to tighten the purse strings. This is quite expensive. How can I make it cheaper? So we're going to start the piece. I'm going to kick it off, and Andy's going to finish it, because this is one of Andy's specialities, actually, being in the insurance realm.
Yeah, and before we start, actually, just to put it out there, the last thing you should do, really, is cancel your cover. Think about what we're going to talk about in the next 10 minutes and see if you can do any of these tips to bring down your costs. If you cancel your cover, you lose the benefits outright. And if you try and buy the cover again in the future, you'll possibly find, A, you might struggle to get the cover if you've had any health issues, but B, you'll probably end up paying more. So that's the last thing you should do. What's the first tip?
I mean, the first one is, again, we'll link to the article this relates to. We're going to publish an article based on what we're talking about, is to speak to a specialist. Now, there are people who you will find linked to in the article, but if you speak to an insurance specialist, they will be able to look at the product you have, drill down, because there are some real nuances between products. It's not a universal product, private medical insurance. They're different from provider to provider in the way they deal with different conditions. They can look at the product and therefore recommend an alternative if it's suitable that could be cheaper, but still provide you with the benefits that you want. You might not want all the bells and whistles that your policy has. Now, one of the main points, as Andy mentioned earlier, don't do anything straight away knee-jerk. If you're about to leave an employer, don't just think that you can't take your policy with you. It is theoretically possible if you've got a policy through work and it's going to be a benefit through work and you're taxed accordingly, but it is possible to continue that policy as an individual. You'll have to ring up the insurer to see if they will allow you to do that. But there are benefits of doing that because you're not restarting a policy from scratch. And with medical insurance, you go back and listen to the previous podcast we've talked about, depending how they're underwritten, some will be fully underwritten, some will be under what they call a moratorium, where they just say maybe a 2-year period. If you don't have any problems, then you're covered for everything. Well, if you've gone through that period, so you're now in a phase where your policy's been around for a number of years, you would be covered under the policy for a lot of things. Then if you cancel that policy when you leave and don't continue it, so when you leave your employer and you start a new one, you will likely have to have it underwritten again or go into another moratorium period. So if you can avoid that, it's worth looking at the cost. It may be expensive. It may be you decide not to continue the cover, but it's something definitely to look at.
The next tip, and quite a big tip, this is to stick to the core benefits. So with health insurance, there's lots of whistles and bells. Damien talked about those earlier, and they can be quite complex and quite expensive. Now, of course, you want the best cover you can possibly get. But if you have bolted on additional bits of cover, just to give you an idea, you can get additional cancer covers, mental health options, dental cover, all of that kind of stuff comes generally at an extra premium. And so if you can do without those, then you can actually trim those off and save money. For example, you could just remove one option and it could save you between sort of £70 to £100 a year, to consider that. The next tip is to look at your hospital choices. Now, check your policy details, because on a lot of policies, you do have a choice of what hospitals you're treated at and how many hospitals and consultants you get access to. Now, the wider range of hospitals and consultants you choose, the more expensive it is. So you may well have chosen to have that wide range, and you could trim those down and save a lot of costs.
Yeah, and it may mean you just have to therefore travel a bit further if you're going to go to one, if you trim the hospital list down. But given that we're talking about something that is hopefully not going to happen, you don't have to claim on, I think it's going to be something that's probably preferable to be able to trim down, and maybe you travel a distance should you need to, but you save money. And if you need to save money, that's the priority, but without cancelling the insurance itself.
Another tip is to downgrade the cover you have. Most covers will give you effectively a basic, an intermediate, and a comprehensive level of cover. Now, there's lots of caveats and nuances depending on which insurance policy you choose, but generally you'll be given one of three options in terms of how comprehensive your cover is. If you've chosen the most expensive option, you can just bring that down into the intermediate level. Yes, you'll get slightly less whistles and bells on your policy, but the key is it's going to cost you less, and it doesn't mean you have to cancel the cover.
Yeah, and so it may be like on the basic one that you end up having to be diagnosed by your GP first before you then can go to a private hospital, rather than on the bells and whistle version, you might actually be able to see somebody first for the diagnosis. That's how it works.
Exactly.
So
right,
if you're happy with that, which, let's be quite frank, I would be, then that could save you some money. So it's definitely something worth looking at.
A really quick and easy one next is to increase your excess. So the excess is the amount you pay towards a claim. So hopefully you'll never have to claim on these things. So if you're of that mindset, then why not increase your excess right up? So excess generally ranges between naught, the most expensive, and around about £1,000, which is the cheapest excess you can have on a policy.
And so I'll quickly round up the last two, really. Pay annually, which I know if we're talking about cutting costs, seems a bit counterintuitive, but if you do pay annually, you'll probably save about 5% a year. I mean, I tend to pay for quite a number of insurances annually, house insurance, for example, car insurance, because it does make it cheaper. And the last one is to shop around when you receive your annual renewal quote. Medical insurance is different to other types of insurance. You take out a life insurance policy, it will usually be for a designated term, and it's usually going to be for a guaranteed premium. So therefore, once you take it out, the contract's in place, it's rigid, you know the price you're paying. With medical insurance, what happens is every year there is a renewal that occurs, but you don't have to accept the premium that's offered to you by your insurer, because it can change. It's not guaranteed to be the same as you paid last year. So you can then shop around. So going all the way back to the first point I made, then it is worth speaking to a specialist who knows the market and can actually give you a policy that perhaps, even if you do end up paying less, sometimes occasionally you can get covered for things you probably didn't realize you could. I mean, there's a good example we were talking about in the office today. Particular insurers might deem a particular condition more generously. So let's say back problem. Some insurers, if you had a lower back problem, would exclude anything to do with your back, whereas others may actually allow you to be seen or claim under their policy for a problem that's at the top of your
back. Your neck or shoulders, whereas others might exclude
so those sort of nuances, it's worth reviewing your policy anyway, because these things change and you may be able to get something that you didn't think would be covered, even possibly for a bit less than you're paying now. So it's definitely worth reviewing.
And speaking to an expert, what they'll do is they'll ask you to list off the benefits, and over the phone they'll be able to compare those on the screen, and within just a few minutes so you'll have 5 or 6 different options and prices, and you can compare those. So
yeah, and when it comes to renewal again next year, you can then upgrade again. Let's be honest, this isn't a one-way street. This is like reviewing, and you could change the benefits when the circumstances have improved financially. So moving on to the final piece of the podcast this week. I mean, I've sat down, and because we're all, and I'm going to date the podcast here, if you're listening to this in a few years' time, you'll probably look back at the pandemic and think what we worried about. But it looks like we're all going to be spending Christmas at our own houses. And so my wife and I, we were sitting down looking at what we're going to buy for food for Christmas, because the supermarkets have all released their collection dates for you picking up your turkeys, etc. Hence why I was looking at this kind of stuff. And so it got me looking at the idea about supermarkets, and it was quite timely. Jordan decided to do a bit of analysis for us about supermarket spends and about the loyalty cards and which loyalty scheme at a particular supermarket provides the best value for money. So what did his research show then?
So Jordan picked out the top 4 really that were best to compare against each other. There are other supermarkets that do a slightly different offering, but we've left those off because we want to be able to compare like for like. So the 4 supermarkets that Jordan looked into were Tesco, Sainsbury's, Morrison's And a new entry to this kind of thing really is Lidl as well. Lidl have come up with their own type of loyalty scheme, which is very interesting. So the first thing to really do when we're comparing these things is how much are these points worth? What can you earn at each of the supermarkets? So we looked at a £500 spend, which is kind of an average spend that a family might do in a typical month. So at Tesco, if you spent £500, you'd get 1% in terms of your rewards, which is worth £5. At Sainsbury's, you would get 0.5%, just 0.5%, which is worth £2.50. The Morrison's Match and More card would also give you 0.5%, 0.5%, which returns £2.50 for every £500 spent. Now, here's the kicker. If you've got a Lidl Plus card, then you would actually earn £12 back, which equates to 2.4% on a £500 spend. But actually, I'm going to talk a little bit more about the Lidl Plus card because it's actually better than the 2.4% that I'm reporting there, because actually you can earn £12 back for just a £200 spend. So with all the other ones that we've mentioned, you accrue the points based on every pound that you spend. And it's a simple formula. For every pound you spend, you earn X amount of points. And we've gone through the numbers there. With Lidl, once you spend £100, you'll be given a £2 money off voucher, which you can claim against your shopping. Once you've then spent another £100, and it's all done on a calendar month, it's timed, it resets every 30th, 31st of the month. Once you've spent the second £100, it triggers a £10 voucher, which you can claim off your food. So you only need to spend £200 in a calendar month to earn £12 back, which equates to a 6%.
Yeah,
reward.
that is a pretty good reward, because when you showed me the research, I was quite surprised, because that is pretty good. I mean, you do have to go in store. Lidl doesn't do online as far as I'm aware, so that is pretty good. I suppose the only other thing you've got in there that you throw into the mix, which I see you've got down there, is about trading up points.
Yeah, so the bigger supermarkets do have a few more whistles and bells to their loyalty cards. So Tesco, for example, you can trade in the points and you can get more value for those points if you trade them in for, say, theme park vouchers. And
I remember back in the day they used to do 4 times the value for things like I think one of the jewelers and stuff like that. So
that's it, partner reward. So if you spend at the partner, you'll get the reward back on your card from spending at
but like Sainsbury's do a similar thing, don't they?
Yeah, it's another thing to point out about Sainsbury's actually, with Christmas coming up, they do a double up. So leading up towards Christmas, any points that you've accrued, you can trade those in a particular time frame. I think it's in November, and say you've got £10 worth of points on your Nectar card. If you exchange them in that week, they'll double them for you. So your £10 is worth 20. The kicker being you need to spend them on certain things, and there's a deadline. It's because Christmas is coming up. You have to spend them on certain things just before Christmas, or you use them or lose them.
So, I mean, that's a great piece of research. You can go through and look at it online. We'll put links to it again so people can look at the full analysis. And again, if you take some of the stuff we've been talking about in recent weeks, which is including cashback and credit cards, and we're always updating our credit card analysis. Laura is doing a hell of a lot of credit card analysis at the moment about the best cards for things like balance transfers, cashback. So you combine all these things, you can get some pretty decent returns. And since lockdown, if you are like me, then one of your biggest bills has been rapidly becoming your food bill, because where we can't go out and do things so much and we're eating more at home. So Jordan, by osmosis and drip drip, is slowly getting me to get on the points bandwagon. And this also came about because I looked at the prices of the food that they put in their special sections on their website to do with, like, if you want to buy Christmas turkeys and all these sorts of things. They are a con. They clearly ramp their prices up on the most basic things. So you have to buy a really expensive Christmas pudding rather than their cheapo £1 one, because you can't have that included in the same delivery or collection slot as when you're buying stuff for Christmas. So they make you, if you don't want to have to go back into the store, which anyway, I'm ranting now, but it's basically really expensive. So you might as well collect points if you're going to end up being robbed by these supermarkets.
And another reason this is timely now is because of the pandemic. The supermarket pulled all of their offers anyway, because it was a saturated market. Everyone needed food, so they pulled all their offers. So if you can get a little bit back by using your vouchers and being wise about it, then why not?
Yeah, why not? So that's it for this week, isn't it, Andy? So don't forget about the event on Monday evening. You'll see me live having a chat with Purple Bricks and Habito. We'll include some of the highlights in next week's show. So if you can't make it, then don't worry. But if you want to see the full event, it's the only way to see the full event is to go online and watch it on Monday.
That's it. So we're done for this week. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Check out our Facebook group. group, it's facebook.com/groups/money to the masses.
And the other thing I forgot to mention, which I was incredibly excited about this week, were the umbrellas. The Money to the Masses umbrellas.
That was going.
And so go on our social media. We've got a bunch of umbrellas. We may allow people to somehow win them. I mean, they are expensive. But
they are expensive. I was thinking, wow, you're brave.
But have a look at them anyway and give us your feedback. So until next time.